Hi, this is Brian Vendig, President and Chief Investment Officer here at MJP Wealth Advisors. There's a lot of information and news that has been happening, as we all know, to kick off 2025. And as we start the month of February and we're in the middle of earnings season, I thought it'd be a great time to check in with all of you and especially talk about a lot of the uncertainties that seem to be certain this year as it relates to policy decisions coming from the new administration in Washington. So with all that being said, let's jump into it. So when we take a look at this week, February 3rd, it's one of the busiest weeks in the market regarding earnings. Over the last couple of weeks, we've heard from about 40% of the S&P 500 companies. They have shown to grow earnings more than 13% year over year, beating on the bottom line close to 80% of the time. And at the same point in time, we've seen revenue growth expand by 5%, beating analysts' estimates by about 70% of the time. Now, this is actually above where we saw analysts expecting earnings to grow year over year for the fourth quarter. Again, companies reporting in January and February, talking about results of last year and what they expect over 2025. I think this is a year where earnings has to do a little bit more of the heavy lifting than we've seen in prior years. And the nice news that we're seeing from the earnings reports is that earnings are expanding in areas out of mega cap tech, which I know is a theme that we've been talking about for the last couple of years, and one that we expect to continue over the course of 25. As you can see from this slide, we're also expecting earnings to grow over the balance of the year. But again, these are all numbers and estimates ahead of what could lie ahead regarding policy decisions, which I'll get to and talk about further in this discussion. Now, our view over the course of the year is that earnings should grow on average about 10% more. That's something that's really important when considering where valuations are right now in the market. So when you think about your equity portfolio, we are still leaning in the direction of growth because we still believe in this technology innovation that's playing out with artificial intelligence. We've seen huge spending coming from publicly traded companies on the hardware side. But I think the theme for 2025 is a little bit more of shifting from hardware and building out data centers to hearing more about how AI can help us be more productive both in society and business. And I think maybe a little bit more of a shift to other companies downstream in the technology space in software and solutions. But the bottom line is the tech sector, momentum stocks, the S&P 500, they're all well above historical valuations. And what investors are forgetting is the added expression of why it makes sense to stay diversified and looking for opportunities in areas where you don't have to overpay for growth. And that's why in your portfolios, we might have a step in this growth direction, but we still have plenty of exposure in the other large cap companies in the value space where we're talking about financials, healthcare, industrials. But also keep in mind, we have exposures in medium-sized companies or mid-cap stocks and smaller cap stocks where, as evidenced by this slide, the S&P 400 and 600, and looking at companies that are a little bit more value or revenue focused, are not as highly valued and have an opportunity, we think, for a little bit more earnings growth. So again, trying to stay balanced within the equity complex, recognizing that valuations are at historical highs. Now, one thing that obviously has come out quite a bit over the last couple of weeks and information that we're dealing with today, even on February 4th, is tariffs. And we know, as I've said before, that policy risk or uncertainty coming from policy decisions is the biggest risk to the overall performance of both stocks and bonds in 2025. We've seen a little bit of a grace period given now on Mexico and Canada, and all investors are keeping a watchful eye on that. It's a very binary environment. When you hear tariffs being announced, you see the market taking a sidestep, risk assets coming off, yields coming down, bond prices going up. And at the same point in time, when you see that tariff news and negotiations are being planned, you see a little bit of a uptick in the market. We don't expect that binary nature in the market is going to change anytime soon over the next 3 to 6 months. So volatility is something that investors do not like. We haven't seen a significant amount. We have seen volatility over the last couple of years, but it's been in pockets. I think this year will be different. We are going to see extended periods of volatility, markets trading in a range. That doesn't mean the investment thesis is broken. I think it's just that we have to get more information so that we don't overreact because things move so quickly these days. And right now we have China pushing back on the US with US tariffs increasing on China, China retaliating in some specific areas. But I would say that's actually more of a political move by China because it's only impacting about 8.5% of goods that US imports into China, and it's in very targeted places. So we're hoping that negotiations do continue, obviously, with the two largest economies in the world. Because if things do break down, it will be disruptive to supply chains. It will be disruptive to publicly traded companies. And I will say, honestly, that is where we definitely need to relook at risk in portfolios and need to be a little bit more protective. But as of right now, I wouldn't say we're in that range. And one thing I'll point out is going back to my comment about diversification when looking at this slide, is we've seen tariffs before, obviously, in Trump 1.0. And when you look at an environment that had quality earnings growing while we had deregulation, policies that were supporting private sector growth, and tariffs increasing, we still saw relatively good performance by the S&P 500, but we also saw outperformance with companies that were more domestically focused, hence small cap stocks. And so when I go back to the point that I made before, we have those exposure for small caps for a reason. We think the valuations are attractive, earnings growth are there, but it's also a little bit of a hedge to what can happen in global trade. But we also are trying to remind you as investors is that we move through the next 3 to 6 months around this whole tariff conversation. If earnings is there and can do the heavy lifting for the markets, it might not be a bad news item overall over the course of 2025. Now, one thing that we do know, and I want to put this slide out there, is because the market has been influenced by the biggest contributors of profit. So when you look at the 40% of where market cap weighting is, or 40% going to the value of the overall market to the biggest companies that are out there, our friends in mega cap tech land, again, that is a phenomena that has existed for quite a while, in our opinion, but one that's obviously accelerated. And so what we've seen where markets sell off or take a breather is those higher valued stocks bear more of the brunt on the down. And that's why I'm trying to reassure all of you that you're not just over indexed to 5 or 7 names in your portfolio, but definitely something that quality of earnings coming from the biggest contributors of earnings is still very important, as I'm saying, in 25. So we're expecting earnings growth from tech to be about 20% year over year, but we're also expecting earnings growth to come up from those other areas as well to try to balance out the equation. Now, as we kind of think about this and moving forward, let's shift to the labor market. Labor market, we're going to get jobs report on Friday. Labor market, it seems to be very stable. Wage growth coming down. People still making more, 4% more year over year. Consumers are spending. But obviously, the risk to these policy decisions is that if tariffs pass through increases in prices on consumers, well talked about already in the media the last couple of weeks, that increases the probability of inflation to go up. So when we look at the China, Canada, Mexico tariffs as originally proposed, that could have impacted, if they all went through as announced, that could have reduced overall growth in the US by 1%. And if you keep in mind, just over the last 3 months, the US economy grew a little over 2%, but less than 3%. That's a big deal on a full year perspective. So that's something we have to keep an eye on, because if growth is negatively impacted by tariffs, then we have some concerns coming back with the labor market with layoffs, which then reduces consumer confidence, which then reduces spending. And now we're talking about an economy that has a potential to contract. So we have to be aware of these domino effects. I'm just letting everyone know right now we're not there yet, but it's being aware of the unintended consequences of policy decision, which is why we're staying laser focused on these things over the next couple of months. But what we're seeing so far is consumer sentiment still being strong, spending in the economy. The outlook so far are holding solid for companies that have reported thus far. And this is a big input into obviously future Fed decisions as well as it relates to interest rates. And when we come to interest rates and inflation, one of the key indicators that the Fed uses to make policy decisions is the personal consumption and expenditure inflation index. You might hear the PCE. This is around 3%. And so if tariffs do come into play at these dramatic levels, if policies go to extremes, we do expect prices to go up on average for the country by 0.6%. So you could say we're around 3%, maybe that might go to 4%. That would definitely be an issue for the Fed. I think that would be an issue for most Americans as well, when considering the price of things already today in some areas and different parts of the country. And so as a consequence, we have to be sensitive to this. Now, if the economy slows and there's less demand, that also could be disinflationary. And at the same point in time, if Congress extends the current tax rates, passes policies that help to support more growth in the private sector of the economy and controlling some elements of government spending, that could also be supportive of being disinflationary to inflation. So it's not just a one-sided coin. So a lot of moving variables is what I'm trying to say. And we're trying to put together and understand how those puzzle pieces come together for you. But at the end of the day, if policies don't go to an extreme, our message is still this. If earnings is there and can do the heavy lifting for the market, then we're still expecting positive returns for 2025, but not to the same level, of course, that we saw in 24. If inflation stays in check and the Fed comes to the rescue with a cut or so at the end of this year, I still think it's possible that in term to longer term interest rates come down, which is good for bond investors because prices go up. But as decisions and negotiations are made on trade, as policies come out of Washington, we have to be aware of those things because obviously if things counter those thesis points, then we'll take action on the equity side to be more protective. But again, as I said, earnings coming in solid. We're not there just yet. Trade negotiations still happening. No reason to get whipsawed as these things play out. And on the bond side, rates are steady. Rates have come down. Bond prices have increased. That's a good news item. We have made some changes over the last week or two on bonds to be more flexible and adaptable, but also to pick up more income for your portfolios as well, with interest rates shooting up after the election and then coming down at the end of January. So that's what we have for now. That's the update, but we'll keep you posted as more will play out over the next weeks and months ahead. So thank you very much for your trust and support. It's always a privilege to work with you and your families and your businesses. And thank you very much for your time. And we'll keep you posted, as I said, as the weeks progress.